All right, let's dive into the latest earnings from Alpha Metallurgical Resources. Now, on the surface, their second quarter numbers for 2025 looked, well, a little mixed. But the way the market reacted, that was a totally different story. So let's break down what really went on here.
So here's the big question, right? AMR's revenue, about $549 million, actually came in a little light of what analysts were hoping for. And yet, the stock just absolutely took off, surging over 15%. So what on earth did the market see that the headline number didn't show?
The whole story, the reason for all the excitement, it really just boils down to two simple words: cost control. And we're not talking about some minor little adjustment here. This was a huge, fundamental shift in how they run their business, and it completely changed the narrative of the quarter.
Okay, first things first, let's look at the numbers that created this whole paradox in the first place.
I mean, just look at this split. It's a tale of two completely different numbers. On one side, yeah, you've got the revenue miss. Not great, but, not the end of the world. But on the other side, their earnings per share, they didn't just beat expectations. They absolutely crushed them by over 80%. And that is what got Wall Street's attention. It was a massive signal that the real story wasn't about sales. It was about profits.
So how in the world did they pull that off? Well, that brings us right to the heart of the matter, a truly masterful job of managing their expenses.
And this chart, it says it all. Just look at that drop. They managed to slash their cost of coal sales per ton by more than $10 in a single quarter, from over $110 down to just about $100. Let me tell you, in a commodity business like this one, that kind of efficiency gain is absolutely enormous. It's a game changer.
And this wasn't just a fluke or a one-off good quarter. It was historically good. The CEO, Andy Eidson, even said it himself on the call. This was their best cost performance in 4 years. That's what gives this whole thing weight. It tells the market that a real sustainable change could be happening here.
So you're probably asking, how'd they do it? Well, the key thing is, it wasn't just luck. It was a full-court press. They boosted productivity, tons per man-hour, by an incredible 10%. That, in turn, helped bring labor costs down. And on top of that, they were really disciplined with their spending on things like repairs and maintenance. This was a ground-up operational win.
And here's the proof that management actually believes they can keep this up. They went ahead and updated their guidance for the entire year. They're lowering their expected cost ranges, and they're even increasing their forecast for interest income. When a company does this, it's a huge vote of confidence in their own new, leaner way of doing things.
Okay, so they've got a new grip on their costs. Let's see how management is planning to build on this much, much stronger financial foundation.
And that foundation is rock solid. They ended the quarter with nearly $557 million in total liquidity. I mean, that is a serious war chest. It gives them a ton of flexibility to handle the ups and downs of the coal markets and to invest in what's next.
Now, this is a big one. One of the most powerful signals they sent was restarting their share buyback program. They hadn't done this for over a year, so turning it back on basically tells shareholders, hey, we think our stock is cheap and we're willing to bet on ourselves.
So, looking down the road, management has laid out a pretty clear map. By the end of this year, they've got a new mine, Kingston Wildcat, starting up. That's new volume. Then 2026 is a big year for contract talks, and further out, they've got a major infrastructure project finishing up in 2028. So lots to watch.
But you know what? On top of everything they're doing themselves, there's this huge external wild card that could give them a massive financial tailwind.
It all comes from this piece of legislation with a memorable name, the One Big Beautiful Bill Act. Now, what it does is it amends the tax code, specifically Section 45X, to officially label metallurgical coal as a critical mineral. And in plain English, that just means producing it now qualifies for some pretty sweet tax credits.
So how valuable are we talking here? Well, the company's own initial math suggests this could be worth between $30 and $50 million a year in cash benefits. And that's from 2026 through 2029. That is just a direct shot in the arm to the bottom line, courtesy of the government.
Okay, let's put it all together and start looking forward. What's our big takeaway from all this, and what does it mean for the next earnings call and beyond?
So here's our core thesis. We think Alpha Metallurgical is doing way more than just surviving a tough market. They are fundamentally retooling their whole operation to become a permanently leaner company. They've proved they can control costs, and with new mines coming online, they have real options for growth.
All right, so for our investment committee, we cooked up what we're calling an outrageous but plausible trade idea. Here it is. The long-term play is to buy a 2026 call option, maybe around the $160 strike price. You're betting that the cost-cutting, the new mine, and that tax credit will really push the stock higher over time.
Now, to help pay for that, you could hedge it by selling a put option for the end of this year, say around a $130 strike. That's basically a bet that the stock won't fall below that level because the company's own buyback program should act as a pretty strong safety net.
So based on this whole analysis, the operational turnaround, the solid balance sheet, and the clear catalysts on the horizon, our official rating is outperform. Of course, this is not financial advice.